I think there's a big runway still to come in terms of private credit. And I think it's driven by a couple of things. I mean, first, as you just said, Paul, when you laid it out, the banks have been obviously on a bit of a diet over the last decade, and that's really advantaged some of the private credit players. But I think there's another diet to come. If you look at the Fed proposals, the Fed may be asking the banks to take as much as a 35% increase in capital for their investment banking businesses. Right. Now, I'm sure it's going to get watered down, but that's an enormous squeeze, which means the banks need shared assets. And then secondly, you obviously had Mark Rowan from Apollo on earlier today. I think also the regional banks in the States have really got some issues and are selling assets at quite good prices too. So there's an opportunity set of banks shedding assets. And on the other hand, clients just desperate for yield. The biggest source of inflows this year is into private credit. As Jess was just saying, it's grown wildly, but it might double again in the next 2 to 3 years. So for the moment, I actually think the conditions remain very ripe and a really good year for opportunities.
Do you see any sort of red flags brewing within the private credit market at this point?
No, it's a great question. So look, as a long-time banks analyst, any market which grows too fast always creates at least an amber flag, if not red. And look, there's a bit of frothiness, particularly if you look around leverage lending. Prices are becoming tighter. That area is really heavily bid. For the note we put out last week, I worked through that 28 traditional asset managers have either bought another private credit firm or set one up themselves. So there's clearly a bit of frothiness around the leverage lending area. But if I look at the kind of off the run deals, whether it's buying bank assets, whether it's more esoteric lending, it still looks quite an attractive spread. So I think the leverage lending is probably the area to look at. And then the second one, of course, is who's the right buyers? Are the buyers ones who understand this is a long-term asset? Because you're basically getting assets which used to be run by a bank, but are now going to get run by a fund manager. Do they have the right skills to work out? Do they understand this asset's going to be illiquid? And as ever in life, we hope that the right buyers buy the right assets, but that doesn't always happen. So that's another area that I'm very watchful for.
Huw, why do you think the banks are allowing this to happen? I mean, when I was at the Chase Manhattan Bank, we made a lot of money in our leverage lending business. I'm not going to let that business go to the private market. What's happening on the other side of the street?
Yeah, do you know, it's a great question, and it is extraordinary that you're getting even some of the US's largest banks setting up new private credit units. It's really a consequence of regulation. The Fed, or in Europe, the ECB, are trying to jack up the capital charges to hold leverage loans on the balance sheet. But it's not also even just holding them; it's also the trading of them. Now, as you know, and you've spoken about in the last few months, there's an intense battle, a discussion going on between the banks and the Fed about what is the right level of capital for the risks they're running. And the large banks clearly think that they've got sufficient capital. But if the Fed were to apply the rules as they're currently proposed, as I said, it's a 35% increase. That's so ginormous. The banks will clearly need to trim their sheets, shed some assets, be more thoughtful about the marginal loan they make. So I think you're right, Paul. It's been a great business. It should be a great business, but it's kind of in the gift now of what the Fed will do.
Talk to us about the market for private corporate loans, because right now they're facing obviously a very high rate environment for the first time since they really boomed in popularity. What do you think this means next year? Because even if the Federal Reserve holds off on raising interest rates, rates are still very elevated. How does that impact that particular quarter of the market?
No, look, I think that is a really good question because the debt is mostly floating rate note. So in other words, it's being passed on to the corporate directly. Look, as financing costs normalize, some of the weaker balance sheets are going to be exposed. And you've started to see that even in public markets in the last 3 or 4 months. The trade between the stronger sheets and weaker sheets, even in the S&P, has been quite pronounced, I'd say, since June. But you're starting to see that move through the private credit market. Is it possible? Sorry, it would be surprising if there won't be some challenges for some of the borrowers. And I think that's also, why the larger players will need to know, can they work out the asset? Can they rearrange the debts? Do they want to, how do they bail in equity if they need to? And I think that restructuring element is going to become probably into the second half of next year and beyond, start to become more notable. But, the current credit dynamics that we're seeing in these portfolios, and admittedly, the data could be better, but from what we can see at the moment, they're still performing quite well.
Huw, I mean, I guess my experience is looking at this marketplace that it's been very successful, but it's been focused primarily on the middle market lending. Do you expect to see these private credit funds write bigger and bigger checks going forward?
Yeah, so definitely we're seeing larger checks. So look, you've seen a $4.8 deal, you've seen a $4.9 billion deal this year. I mean, which would be unthinkable even 5 years ago, let alone beyond that. So you're definitely seeing. Look, in what I think one of the most interesting features of finance is how the winner takes most dynamic that you see in tech and other parts is coming into finance too. You've seen it in the big banks. You've seen it in also some of the big asset managers. And that kind of winner takes most dynamic is coming to private credit too. So look, the top 10 private credit players represent about 40% of the fundraising in the last 24 months. And if anything, it looks like it's going higher. Now, that means they can take on bigger loans, as you said, Paul. But also it means that if you've got a mid-cap bank who maybe has got some of the lending facilities from the Fed that they introduced around the regional bank turmoil earlier this year, if they need to shed a few assets to deleverage their balance sheet, they're going to go to one of these top 10, top 15 firms. So it's not just mid-market lending; it's the larger firms are doing much more, taking opportunities of quirky off-the-run portfolios from banks. And as you saw that with Credit Suisse earlier in the year or last year, I think this is actually a really interesting seam for some of the more skillful players.